clearly Eric and I share sentiment, because he's like, let's just get this the hell over with. My actual talk is called, we've just got to get through this. So we're on the same track, and I, like Eric, will not provide any fantastically detailed insights about when things are going to bottom. But I am going to look through where we're going, what I think it means for the near term, why I'm still optimistic in the long term, and how we got to where we are. And I think I have a lot to go through. I try and keep my MIF talks to like 12 slides, and this one's like 16, because there was just so many things to talk about. So pardon me if I go through some of these a little bit quickly. I really think, and yes, everybody's talked about inflation ad nauseum for so long that like we're kind of sick of hearing the word. The reason that I'm starting with inflation is because despite everyone talking about inflation all through 2021, nobody actually acted like it was happening. The markets didn't actually act like it was happening because they didn't want to. They didn't want to acknowledge that really strong, persistent inflation was going to change the monetary landscape in a way that we haven't had to deal with for over a decade. No one wanted that, so they ignored it. And then in Q1, we were forced to acknowledge the need to fight inflation, right? The numbers became stupid, like they got to, whatever, 7.4 in January or February, and that steals 40% of your purchasing power in 10 years, right? Those are numbers that you start to be, that are unavoidable. And then, of course, Russia invaded Ukraine, and that poured fuel onto the fire, and the need to fight inflation became undeniable. And the reason everybody had been not wanting to acknowledge that elephant that just kept getting bigger and bigger in the room is because it sucks. Like, it's no fun being in an inflationary environment, especially when the market that has been raging and so wonderful and doling out returns to everybody for so long had been based on the opposite kind of financial conditions, right? And for those to change is a dramatic shift, right? It requires a complete change in a lot of investment approaches. And so when that reality of significant tightening ahead became undeniable, and importantly, everyone had to acknowledge that the Fed was going to tighten regardless of what happened in the stock market. 6 months ago, I was saying, 8 months ago, I was saying, if the market starts to tank, the Fed will back off. By the time we got to even the last MIF, no, that's no longer the case. The Fed will persist and is persisting, as we see right now, despite a market correction, crash, slide, whatever word you want to use. And so we got all the reactions that we've all been seeing over the last 6 weeks, right? The bond yields have priced in hikes through to the end of the year. Investors have fled richly valued tech stocks. Growth stocks have, which were the things that powered the market for so long, turned down. And this really matters. This is what I've sort of already addressed here. For the 2 years, especially since COVID, but actually also before that, since the great financial crisis, risky bets seemed to pay off for investors, maybe not mining investors, but in the rest of the market, risky bets were really paying off. And dips were always buying opportunities. And so that created this just buy, buy, buy mentality. And then when monetary policy was able to stop the COVID crash in its tracks, that cemented the idea that recessions, we don't need to worry about those anymore. And risk-taking went wild, right? We saw money pouring into profitless SPACs and, tokens named after dogs that were actually intended to be a joke, but then were taken as a real thing, right? Like, risk-taking really went crazy. And I think this context matters because it explains what's going on. Risk-taking is making a 180, and it needs to, because all of the financial setup that supported those risk actions is now different, right? And so that's why everything's changed so much. The key forces that pushed markets up, one of them that I love to point out, and I think I've probably given this example at MIF before, so pardon me if you've heard it before, but Apple had 3-point-something%, growth year over year for years. And then in 2021, they had 33% growth. Why did they jump so much? Because everybody needed to buy a tablet. Because them and their kids and their grandparents and everybody needed to be from home. That's why, Netflix went crazy. Everybody was at home. There was a very significant pull forward of demand for tech because of COVID. Now that pull forward is done, and so the contrast, so Apple's growth this year, I keep saying NASDAQ thinking NASDAQ when I meant to see Netflix. Netflix cratered. Well, that's because you can't pull forward demand and then expect demand to persist, right? That's what pulling forward of demand is. It uses it up. So a bunch of the things, both real, that pull forward of demand from really strong need for tech during COVID, and the turnaround of risk just mean that all of those things are turning around, they're reversing. And it's happening because the big inflation of the day requires the opposite of the kind of support that created those markets. And it's been dramatic, right? 35 trillion erased so far. That's 14% of financial wealth. For reference, the great financial crisis was 19%. So it's been significant. It's been a very significant decline. Of course, the question is, what's next? And here I am not going to blow sunshine. I'm sorry if you wanted me to, but that's not what I'm going to do in the near term, okay? And that's what's important. What I'm about to describe is for the next few months. What are we going to expect for the next few months? And I think the best case is sort of sideways. And the reason is that we really need to see if it works. And by work, I mean if tightening of financial conditions, which we're seeing, there's less money going into profitless SPACs, right? IPOs have come way down. Financial conditions are tightening. We need to see if the tightening of financial conditions actually turns inflation around. If it does, then we can move on from there. If it doesn't, then problems get worse. That's the next slide. And there's reason to believe that that can work, that the Fed can thread this needle, so to speak. And that the reasons for that is that the economy is pretty darn strong. Unemployment is very low. That's really important, right? US GDP is supported 70% by consumer spending. Consumer spending remains strong if people stay confident that they can have a job. When there's such a demand for workers, right now that confidence exists, and so spending is persisting. So unemployment is low, household wealth is pretty high. I mean, it's pretty correlated to the stock market these days, so it's come off in the last month, but household wealth is high, the strong US dollar has pro and con effects, but maybe buffers inflation. Of course, there's other potentials. That's the best case scenario, a sideways market until inflation eases, and then we can move forward from there with growth persisting. The bad, badder, and baddest, and I actually don't know whether the second and third of which order those should go in terms of which one's worse. Bad is that the markets continue to sort of skid downwards while we wait for this answer about inflation. Growth persists, but the markets continue to bleed. And that's definitely possible. I mean, on historical bases, tech stocks are still pretty strongly valued despite all the ground that they've lost. There's reasons to believe that it could slide further from here for sure. And then the other options are stagflation. That's the one that maybe should be in the baddest category. I just had to put them in one order or the other. And the stagflation is, of course, where inflation doesn't go down, but tightening chokes off growth. So we get no or very slow growth, but still really strong inflation. That's a bad scenario. That's probably the one that we want to avoid the most. And the other bad scenario is that that tightening works too well or too quickly, too aggressively, and we get a recession and an actual crash even from here. These things are all very much on the table. I don't know what's going to happen. There are still more destabilizers ahead, and how some of these things play out will matter in answering this question. One thing that I've been reading about in the last week that I think is interesting is that a lot of the retail traders, remember during COVID when the Robin Hood phenomenon, a lot of people staying home, had money, weren't spending it on trips or concerts or things that they might usually have, and they were home, so a lot of retail money entered the market. That was a really significant inflow, again, that boosted some of those tech stocks that were, couldn't fail. A lot of those retail traders are still largely in the market. A lot of the money that has left the market has been bigger money, more institutional money. And so if or when there's a large move amongst that retail crowd to leave, well, that's definitely going to be a negative. That would be a negative impact up ahead. And it is important to note that all the retail favorite stocks, the gains are gone. Like, we're back to sort of COVID crash levels, mostly, or a little bit after, for those retail favorite stocks. So that might be just around the corner. And then there's the bigger picture, social, political setup. And I think one of the biggest things to consider here is just food insecurity, actually, and the fact that wheat prices have gone up dramatically. The next slide I talk about fertilizer prices have gone up dramatically. I mean, we know that Ukraine and Russia produced 30% of the world's wheat. A lot of that wheat goes to North Africa. You know, this has real potential for destabilizing. And we all know that destabilizing events, the market doesn't love them. So these are other factors that are in play that we certainly need to watch, and that may come into play in a very significant way or may not, right? There's a lot of unknowns ahead. What I think is really important to note are two things. There is this cushion, which is what I was speaking about before, which is that we do have a strong economy in North America in particular. We have high household wealth. We have low unemployment. We have, like, growth remains good. So these things really help, and they can definitely cushion the impacts of tightening. It's not easy, and as I'm sure Eric will say, because it's one of his favorite things to say, the Fed's track record in engineering soft landings is pretty darn low. So I wouldn't, lean into the Fed doing that. But it's possible when there is a lot of strength out there. And so that's one factor. And of course, so the up and down of that, though, or the pro and con of that, is you can see it a bit in some of these graphs that I've put up here. So like the one on the bottom, which is unemployment. Yes, unemployment is nicely low. It's at historically low levels right now. Of course, you can see that in recessions, obviously unemployment goes up. So if you're a glass half full person, you think of low unemployment as supporting growth, supporting consumer spending, being a cushion to tightening. If you're a glass half empty sort of person, you say, oh, well, then now there's room for unemployment to run, and they won't care if they cause a recession as long as they get inflation under control. And both of those perspectives are correct. So, it sort of depends how you look at it. And the fact that both of those are correct is one of the reasons that I have spent a lot of time trying over the last few weeks to figure out what's going to happen next, and I don't know. I can't know. So what can I do? Well, I can look at the past that I think are likely. So nothing very exciting or good over the next few months. Potentially more downside, potentially sharp downside, or just like long, slow, grinding, boring downside. What I need to do is decide what to do about my portfolio ahead of that, a little bit late for the ahead part now, during that, and then after that, right? That's all you can do, is try and decide what you want to do with the scenario that you're being presented with, because you can't change it, and so you have to decide what to do about it. One comment to remember is that gold certainly loves when things are crappy, right? Gold loves a market crash. I mean, Jordan is speaking tomorrow, so I'm sorry if I'm stealing this line from him, but he emailed in a note yesterday just this example about how every big move in precious metals markets began around, during, or after a more than 20% decline in the stock market, and that happened in the early 2000s, in 2007 to 9, in 2015, 16, in 2018, and 2020, right? It's a pretty reliable pattern, so that is definitely important. And what I think I want to add a little bit to that, referencing the appeal of gold over the last 2 years. So we have obviously seen the price of gold do very well since COVID, right? It's done fantastically. In fact, we've seen $23 billion of inflows into physical gold exposure since COVID, and that has been safe haven buying because there was uncertainty, because COVID changed everything. But during that same time, gold stocks saw $1 billion of outflow, which was very frustrating for all of us in the market. And the question of why is, the answer is that the broad market was still kicking it. So why, so what people were doing was getting their safe haven coverage by owning physical, but they didn't feel the need to own Barrick, let alone a developer or an explorer, because they could own Netflix, they could own some, monkey meme, NFT, they could own those things, and that's what was working. And so why do anything else? When the broad market stops working, which is, of course, the message that I started with and that I think is really important, is that that broad market has changed. Regardless of what happens over the next few months, we are not in a super loose, financially supportive monetary environment anymore. That is not going to be the case. And so the outlook from here in terms of investors will have shifted, whatever happens, whatever sort of down happens over the next few months. I think when we come out the other side of it, perspectives will have shifted. And so when that version of the broad market that everybody bought into aggressively for years isn't there anymore, then I think perspectives will shift. And I think value stocks will step forward. And so, you know, gold absolutely, as a safe haven and a value stock, I think steps into that role. And then the other key, and it's something that sort of helps me sleep at night, so to speak, is that the green energy revolution isn't going anywhere. The green energy revolution doesn't care what happens in the stock market over the next 4 months, not in the slightest. And the green energy revolution is a paradigm shift in demand for a lot of metals, and there is not enough metal to supply that paradigm shift. And so I think that is the biggest guiding light for me in terms of what I want to do with my portfolio, or what I want my portfolio to be coming out of whatever this near term is. That hasn't changed, right? Many metals are in deficit within a few years because demand is rising, and of course we've been not investing enough in building new mines. I mean, nickel, copper, and uranium stand out in particular to me on the list of beneficiaries from that. They are by no means alone, but they're big markets and they're in clear need. Like Morgan Stanley, no amount of capital can create new nickel mines by 2024 when they are needed. That's a very strong statement, right? I meant to add a uranium slide in here and I forgot. But this really matters. So whatever happens over the next few months, I want to have exposure to this over the next few years, okay? And if this plays out in the investing world the way that I think that it won't matter very much whether I bought a year ago, whether I bought at whatever bottom happens over the next few months, whether I bought a few months after that. What will matter is being positioned, right? So that is the main message that helps me sleep at night, is that I understand my medium and long-term convictions, and so I make sure that I'm positioned for those. My approach, for what it's worth, and this is what I've been explaining to my subscribers along the way. A couple weeks ago, I raised some cash and reduced some exposure. Again, part of that sleep at night thing, part of having cash on hand to take advantage of whatever low transpires over the next little while. It was hard to decide what to buy and what to sell, so you have to make some decisions. This makes sense for me to have sold some and held others for two reasons. The first is what I was just talking about. I remain strongly bullish on metals over the medium to long term. So I want to stay in a bunch of my stocks because I am bullish on metals and because discoveries happen whenever they happen, and I want to support companies that need support because, that's important. And it also makes sense for me because I like to trade part of my portfolio as a hedge for holding the rest of it long, for the reasons that I just said. That doesn't mean that everybody should trade part of their portfolio. It can also make sense to just hold through whatever may come if you agree with the long-term conviction, the medium-term conviction, but you don't like doing the trading side. That's also okay because of the significant support that I think we're going to see for metals coming out of, and I've said a crash here. I think really this is like after whatever happens over the next few months. I mean, in and after a crash, commodities would crash too. We're seeing it right now. We're living it. Look at your gold screen every morning. It's super fun. Your copper screen, it's been great. But I do think that coming out of this, we will see a sharp rebound in gold. We've seen that playbook a bunch of times over the last few years, right? So not only do gold investors know that playbook by heart, lots of investors have seen gold do that out of a crash. So that only amplifies the likely buying after some sort of dramatic market event. And then I think the green metals argument is also very strong and very widely accepted. So I think that there would be a pretty strong rally in metals, sort of like after the COVID crash, coming out of whatever this downside is. And we will come out of it when there's some clarity on what happens with inflation. And so that's going to take some months. I don't know what people's definition of inflation being under control is. I have no idea anymore. Is that like 6%? Is that 7.1, is that inflation under control? Do we need it to get down to 4? I don't know. I mean, we're in a world that I don't know what to say about that. I think we need to see a downward trend. I think people need to have some confidence that it is working, and then we will be out the other side of whatever it is that's coming. But my advice, if you want to call it that, is understand your medium-term and long-term reasons for investing in metals, and if those remain strong, then use this as, take this moment for what it is. You can't do anything about it. Either hold through it, buy into it, play it to some extent if that still makes sense for you, but don't look at your screen in the morning over and over and over, and at some point get so sad and disappointed that you sell, because that'll probably be you selling at the bottom and then not having exposure to this upside when it comes out, when we come out the other side of this, okay? Emotion is a beast, so try not to do it on emotion. Try and do it on conviction about what's happening in the medium and long term in the world, financially, and in terms of the green revolution, and hopefully that works out well for all of us. And that brings me to the end of my talk today.